Everyone, thank you for joining tonight's webinar. December here, so this is going to be the last market update and real estate update webinar that we do for 2025. Once we get into the new year, we'll do another one. Looking forward to 2026. And of course, tonight, along with looking at the last 12 months, we'll also take a look forward towards next year, 2026, and what we anticipate having in store for the future. With that said, let's get into it. We have a lot of information and data to go through, including many new updated slides just for tonight. Real quick, before we get into the data, background on myself. My name is Patrick Kappel. I'm the team leader of the Kappel Realty Group based here in San Diego. I've got almost 20 years of real estate experience. I don't just work in real estate and brokerage. I'm also an owner, like many of you. I own 9 investment properties out here in San Diego and my house. And I began in the real estate industry back in my 20s when I bought my first property. I'm also a board member of the Southern California Rental Housing Association. Our team, the Kappel Realty Group, has sold over $500 million, pretty close to $750 billion at this point now, in just the last 5 years. And as you can see there in the bottom left, I also served in the Navy. It's what brought me out here to San Diego. Served in the Navy for 24 years, both enlisted and officer, both on active duty and in the reserves. You can see the education there. I have a master's degree from the University of San Diego in real estate. I also have an MBA from UCLA with a focus in finance and real estate. And my bachelor's degree I earned at the U.S. Naval Academy. You see a bunch of the awards over there on the right. Team Leader of the Year, Top 1% Team. Our team, Kappel Realty Group, which you can see in front of you, is currently ranked as the #1 team at the #1 brokerage in San Diego. That's based on the number of transactions sold in 2024. You can see the numbers there. We'll see how it falls out at the end of this year, but we've almost grown by 40% with about 143 million sold just this year in 2025 and almost 150 properties. So I share this background with you to show you that I have a combination of the academic background between 2 graduate degrees, both of them in finance and real estate, and also combining that academic background with a boots on the ground perspective, keeping a pulse of the market by running one of the largest, most successful brokerage teams in San Diego County. So with that academic and real world perspective, my goal is to give you a bit of a layout, a bit of an understanding of what's going on in the real estate market today. So with that said, I would also like to invite you to watch many of the other recordings, the other webinars, the other educational videos that we have on our YouTube channel. If you scan the QR code in front of me, or if you just simply go to YouTube and type in Kappel Realty Group, you see it circled in the top left, you're going to find a lot of other videos that have to do with real estate, from investing to home ownership. How do you get into investing? How do you buy a 2 to 4 unit property? How do you house hack? Including webinars that discuss how you can get free money, free down payment assistance money to help you or your family or your friends buy your first home. So check out the videos, subscribe to them on our YouTube, and also the video that we are doing right now, this webinar, is going to be recorded and uploaded to YouTube within the next day. So if you want to watch it again, or if you have any friends that you think should watch this, feel free to check it out on our YouTube channel. Real quick, the sources, I like to give credit where credit is due. You can see the sources where I gathered the majority of the data that we're going to be going over this evening. 2 major takeaways. I always like to kind of start out with the takeaways. What should you get from this presentation tonight? Number 1, if you are going to buy now before prices and competition go up. That's kind of the thesis. And now we're going to spend the next hour to back up that thesis, to show you the economic data, to show you the real estate momentum, and everything that goes behind this sentence, the belief that prices and competition will go up. Additionally, you might say, well, Patrick, you're a real estate agent. Of course you're saying you should buy now. Well, if I truly was going to speak out of both sides of my mouth, I'd say you should sell now. But I'm telling you, if you're a seller, you might want to wait. You might want to wait until the spring. Usually in the spring, which is not too far away, just a few months now, we see prices and competition go up. So most sellers, unless you really need to or want to sell now, your best bet is usually to wait until around March or April to sell. At the end of the day, real estate, like everything, comes down to economics 101, supply and demand. And in San Diego, truly, in the entirety of the United States, we do not have enough supply relative to demand. It's also important for you to know, and I'll get into a slide or two of this during the presentation, as interest rates go down, home prices 9 out of 10 times will go up. We'll explain that a little bit later in tonight's presentation. This sentence in front of you is so true. If you do not own assets, you will be left behind in this economy. I was just talking with someone earlier today about, the last 5 or 6 years have been quite crazy. And they started with a pandemic. And in the summer of 2020, I started doing these webinars. And in that June of 2020, I had a slide of the roaring 20s, the 1920s. And that slide was to illustrate that the 2020s are going to be very similar to the 1920s. What do I mean by that? Well, there was a pandemic in 1919, pandemic in 2020. The government did in 2020 what the government did in 1919, deployed a lot of cash and capital into the economy, into the marketplace, and that caused what always happens when you put cash into an economy. It caused inflation. And that inflation rewards those who own assets and punishes those who don't. For the working person without assets, inflation is usually a bad thing. For the investor with a lot of assets, inflation is usually a good thing. It causes their net worth to go up. And the 2020s are very similar to the 1920s in this one phrase: the rich are getting richer and the poor are getting poorer. And a lot of that has to do with, do you own assets or not? So I've advised my clients, my friends, my family to own as many assets as possible, especially during these times. As I mentioned, the rich are getting richer, the poor are getting poorer. And what is the majority of Americans? Lower income and middle class. The majority are not the top 10%. That's why it's the top 10%. And while the top 10% right now are doing very well, stock markets are hitting all-time highs, the average American is struggling right now. This is why we see consumer sentiment throughout the United States at a nearly 45-year low going back to the 1980s. This last year, monthly job creation has been pretty anemic. There have not been that many jobs created. You can see back going almost to the pandemic to 2022, we created quite a few jobs every year the last few years, except for 2025. We've seen job creation really drop to almost levels we haven't seen in years. This has caused the U.S. unemployment rate to edge up quite a bit. Now, 4.6 is not bad. It could be worse. You can see that during the pandemic, unemployment was above 6%. But 4.6 is not good. Usually, the government, the Federal Reserve, wants unemployment to be around 3 to 4%. Not because they want unemployment, but 3%, that's just people moving around in the market, leaving one job to go to another. Once you start to get above 4, that's kind of a canary in the coal mine telling us there could be dark skies on the horizon. That is why we saw the Federal Reserve just recently lower the short-term lending interest rate. Inflation is still above the Federal Reserve target of 2%. We're sitting a little over 3 right now. Yet we still saw that interest rate drop here in the last couple of weeks. Why is that? Because unemployment in 2025 has been edging up. One of the reasons consumer sentiment is so low. As I mentioned, consumer price index, in other words, inflation, is around 3%. It's come down dramatically since the high of 9%. You can see the majority of the drop in inflation happened in 2023 and in 2024. In fact, really since 2023, mid of the year, inflation has been bouncing around 3%. Now, it's commonly thought that the Federal Reserve, the government, wants inflation around 2%. However, if you go back decades, the average rate of inflation has been closer to 3. So one could believe that the Federal Reserve is pretty happy where inflation is at right now, 3%. They saw unemployment going up in 2025, and this is why they decided to drop interest rates multiple times throughout 2025. And they're expected to continue to lower interest rates going into 2026 as well, perhaps two more times. But I really want to impress upon you that inflation, it didn't go down in 2025. It really went down in 2022 and 2023, a little bit more down in 2024. In 2025, inflation has actually ticked up a little bit. Is it going to go up more? We shall see. A lot of it has to come with the Supreme Court and what they're about to decide. As you may or may not know, a lot of companies, including Costco, a place many of you might shop at, are suing the government about the tariffs, saying tariffs has caused an inflation environment. And a lot of these companies have absorbed the tariffs and not fully passed them on to American consumers yet, but they're probably going to start to unless they win the Supreme Court battle. So we'll have to watch that to see what happens with tariffs. Do they stay or do they go away? That will directly affect inflation. Does it continue to go up? But right now, things are kind of moving in the wrong direction. Inflation is going back up. Unemployment is also going up. And that's something the Federal Reserve is going to have to handle going into 2026. How does this affect housing? Well, it comes to one of my role models, Warren Buffett. He has this quote. He has many quotes. This is one of my favorite. I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful. What does he mean by that? You need to be the individual that makes decisions and moves forward when times look a little rough, times look a little shaky. In fact, I bought most of my real estate during two moments in history: the Great Recession, 2008 through 2012, and I bought the other half of what I owned during the pandemic. And right now, with things looking a little shaky, with consumer sentiment being at all-time lows, I'm out there buying real estate again myself for the first time since 2021. I like to say I drink my own Kool-Aid. I practice what I preach. I started tonight's webinar by saying go out there and buy real estate now before prices go up and competition goes up. I myself am closing on a property. You can see it here in front of you. I'll be closing on this just next week. Many times my friends and my clients ask me, Patrick, what do you think of the real estate market? What should I do? Should I buy? Should I sell? Should I do nothing? And the best advice I can usually give them is to tell them exactly what I am personally doing. I'm out there right now buying real estate. This is a single family home in Hillcrest, actually right next to a duplex that I already own. And because I realize there is a lack of supply relative to demand, I'm buying quite literally on a lot that is zoned for multifamily development, where I can one day add 54 units in an apartment complex that will be developed, because I'm bullish. I am bullish on the San Diego real estate market. With that said, let's talk more about real estate. We kind of took a big macro look at what's been going on with consumer confidence, what's been going on with inflation, what's been going on with unemployment, what's been going on with real estate. So we saw mortgage interest rates over the last 12 months peak in the spring, almost near 7%. You can see here, April of 2025, rates went up quite a bit. That caused the real estate market to not be as robust as we typically see in the spring season. Now, rates have fallen dramatically, almost a full percent over the course of the last 12 months. They'll likely continue to fall. With that, we've seen pretty decent levels of real estate activity going into the fall, going into the winter, and home prices really holding their own. For sale, resale supply has been rising since we saw those interest rates go up. In fact, really since 2022. What you're looking at right now is the inventory of all the homes for sale in the United States. Now, this isn't just San Diego, and this doesn't include brand new developments, brand new build, but existing supply. We saw the obvious peak back in 2007, 2008, 2009. Interest rates went down. We came out of the recession. We went into COVID, and we saw supply really drop. If you were buying real estate or selling it back in 2020 and 2021, you might remember that every home for sale, it seemed, got 10 offers on it, and there just wasn't enough supply. Well, that supply has started ticking up slowly over the last couple of years, but we're still not at the historical average nationally, nor are we at the historical average here in San Diego, which you'll see in a later chart when we zoom in on San Diego. Historical average, though, is usually about 2.2 million homes for sale. And as you can see, rolling into the end of 2025, we're just over 1.5 million. So we're still short on housing inventory in the United States. And as I say, the price of everything comes down to supply and demand. We do not have enough supply. We don't have enough supply, and our population is still growing. As we've all seen, we've kind of shut down the borders. Not as many immigrants are allowed to move into America. However, we still have a birth rate. And our birth rate minus our death rate is still a net positive going into the next decade, the 2030s. It's anticipated that the birth rate will slow down, but not so much that our country's growth becomes negative, which has been seen in other countries, but America's population is still predicted to continue growing. In fact, what really surprised me looking at this chart is COVID-19. Look how much our population was skewed by the number of people that died during COVID-19. Millions of Americans died during COVID-19, more than all of our wars combined. And it really doesn't get the attention that it deserves, but you can see that in this chart, just how much that affected our population. Did home prices go down in 2020 and 2021, though? Absolutely not. They skyrocketed more than ever. And as you can see, even the projections going out into the 2030s are a net positive population growth. The US housing market, when you take a step back, again, we're not zoomed in on San Diego yet. We're still looking at national data. You can see that there is a deficit of both vacant homes for sale and vacant homes for rent. This includes both detached homes and attached homes like condos and townhomes. What I'd like to point out to you, though, the deficit of vacant homes for rent is the light green. The deficit of homes for sale is the dark blue. And as we go back to 2020 to 2022, when those deficits really maxed out, the amount of homes we're short for sale, the blue, really hasn't decreased that much. We're still short quite a few homes, the dark blue, and that trend line, yes, it's become less, but not much less compared to the number of homes for rent. So what are we talking about here? Apartments, high rises, buildings that are built for rent that developers have built. Because over the last half a decade, a huge majority of real estate development has been product that has been brought to market to rent, not to own. Apartment buildings and high rises. So you can see that the deficit of for rent properties has decreased from a negative 2 million deficit to a negative 1 million deficit. The deficit of for ownership homes, though, has not decreased that much. And we're probably going to start flatlining, and this deficit is probably going to remain about where it's at, if not become even a greater deficit. Why do I say that? Because builders built a lot over the last 12 to 18 months, and they're starting to slow down now. And in 2026, it's anticipated they will not build as much as they did in 2025 because they're still waiting for some of that 2025 inventory to be absorbed by renters and home buyers. That said, our deficit of for rent, and quite honestly, even the for sale homes, would be even higher if it wasn't for the fact you see in front of us. Young adults, ages 25 to 34, are living with their mom and dad. I've got a 22-year-old. I can say this for certain. She graduated college and now she's living back home with us. And you can see that really shifted in 2023. In 2020, when the pandemic happened, about 17.5% of all young adults were living at home, and then interest rates dropped quite a bit. Young adults were able to go out and buy real estate. They took advantage of low interest rates, but those rates have since gone back up to more normal levels. And we can see that in just the last couple of years, over 500,000 young adults have had to move back in with mom and dad. And if they're not moving in with mom and dad, they're living with roommates. You can see on the chart to your right, there's been an 85,000 increase in the number of young adults living with roommates. What has this done in a macro way to home buyers? Well, it's pushed up the median home buyer age. Now, it depends which study you look at. National Association of Realtors put out a study saying that the average age of the first-time home buyer is now 40. However, the New York Federal Reserve did another study and found the average age to be 36. The Census Bureau found the average age to be 35. And the truth is, the average age of the first-time home buyer right now today is probably somewhere between 35 and 40, which is much higher, though, than the historical averages, well below 35. You can see going back in the 80s, they were in the 20s. And in the 90s, most first-time home buyers were in their early 30s. Since the pandemic, though, it's jumped up a lot, around 35 to 40 years old. These two charts, what should they illustrate to you? What do I want to convey to you? As much as we say, going back to this first chart, the deficit of supply on the whole supply demand equation has gone down from being a $2 million deficit to a $1 million deficit of housing units. That deficit would be much higher if all of these young 25 to 34-year-olds were able to move out of their mom and dad's homes and go out there and buy real estate. So what am I saying to you? There is still a huge level of pent up demand relative to the supply of real estate out there. Look at this chart in front of you. This shows us of last year. We had what census was just recently done. But when we look at last year's age population, I kind of broke it down into categories. Those baby boomers and older, age 63 and older, most of them already own homes if they were ever able to afford one. Those are your homeowners. Then you've got my generation, kind of millennials to Gen X. I'm 44. I fit right here at the older millennial line. Some of these folks own homes, some of them don't. And then look at the far left where I labeled it need homes. That's your Gen Z. That's your younger millennials. Now I want you to look at this chart and let me ask you a question. Which cohort, which generation is the largest generation? Which generation has the most amount of people? Well, it's those on the left that still need homes. And where are they right now? A huge chunk of them living with mom and dad, living with roommates, all shacked up together. We have not built enough housing for these folks. And mark my word, there is no way in the next 5 to 10 years we're going to be able to bring on the amount of housing that is needed for the Gen Z and millennial generation that has not yet got into housing. It is this huge part of the demand equation that is going to ensure real estate prices don't only stay high where they are, they will continue to increase and go up. Because at the end of the day, the value of everything has nothing to do with interest rates. It has everything to do with supply and demand. And yes, interest rates affect demand because what interest rates are at might mean someone can or can't buy, but that demand is so gigantic, as you can see in the chart in front of you, relative to those who already own homes. We just don't have the supply for them. Now, for those who do own homes, as you can see in the chart in front of you, 70% of current homeowners have rates below 5%. They're not incentivized to sell. The generation that already owns homes, why would they sell and give up a 4% or a 3% mortgage if they need to move out of their home 9 out of 10 times? They're just turning it into a rental property. That is slowly shifting, but keyword slowly. As you can see, those with higher interest rates, the purple, the gold, and the green, they're giving them up a little bit more than those in the blue and in the orange. When I mean giving up, they're willing to sell their homes a little bit more than those in the blue, which have rates below 3%. We're going to start slowly now, going from like a macro look at what's going on nationally in economics to what's going on in San Diego. I love this chart. It's one I share every year. It comes out twice a year. The last time I showed you this chart, it was from April 2025. And twice a year, John Burns Consulting does a survey and looks at every single major metropolitan market in the United States, and they rank them as strong, normal, slow, or very slow. Now, when this chart came out in April, only two cities, only two counties were ranked as very strong, and that was San Diego and Orange County. No surprise, because San Diego and Orange County economically are some of the fastest growing areas in the United States because of the biotech boom and the tech boom happening down here in SoCal. A lot of folks and a lot of businesses moving here from Seattle, from Denver, from the Bay Area into Orange County and San Diego. So back in April, San Diego and Orange County were the only two that were green. They are no longer green. However, they are still doing better than most. As you can see, only 13% of major cities in the United States are ranked as normal, at least. All the rest of the cities, 87% of them, are slow or very slow. As I've said before, and I'll say it again, making San Diego one of the best places in the country to own real estate, to buy real estate, to have a house, to have investment real estate. One of the reasons, too, I'm so bullish on San Diego, not just because I live here, but because I look at this data. Now, existing home sales. What have they done over the last few years nationally? And again, we're looking at National Association Realtor data, and then we'll zoom in on San Diego. Pretty much the same. So existing home sales in 2025, year to date, were up 0.1% compared to 2024, and pretty much also the same as 2023. You can see that we've had about 3 years of lower numbers of sales, and it comes down to the fact that a lot of people that took advantage of low interest rates in 2020 to 22, and we've seen these higher interest rates, as I mentioned. You can also see on the chart in front of you now nationally, the seasonal fluctuations of real estate sales throughout the United States. Usually sales peak around June and then they start trending down. This is why I always tell my sellers, if you want to sell real estate and you're able to choose when you sell it, going to market around March or April is best, because typically nationally and in San Diego as well, we see the market peak, transaction activity peak, and prices peak around May, June, July, and then they start sliding down. We usually see prices bottom out around December, January, making it a good time to buy. Now, if interest rates go down in the fall, that can cause activity to pick up a little bit, as we've seen in the last month or two. And it can also cause prices to pick up a little bit, as we've seen in the last month or two, which you'll see. The inventory for homes for sale, though, even though they have gone up a lot, even though the inventory of homes for sale has gone up a lot in the last 2 or 3 years, as you can see, 1 million to 1.5 million, we are still well below pre-pandemic levels. Here in the United States, we're seeing any given month about 1.5 million homes for sale. In pre-pandemic, we were closer to 2 to 2.5 million. This chart in front of you is important because many people, myself included, have been saying accurately that supply has gone up a lot in the last few years. It has in the last few years, but it's still well below historical trends before COVID. And we have also been saying accurately that demand hasn't really gone up, even though supply has gone up in the last 2 or 3 years. However, let's take a step back and look at 10 years altogether and supply and demand in one graph. Just because supply is larger than demand right now doesn't mean we're oversupplied. In fact, look at 15, 16, 2017, and 18, even 2019. The gap, the delta between supply and demand was greater. The delta, that gap between supply and demand, is still pretty tight. It's just not as tight as it was in 2021, 2022, and 23. 2020 and 21, those were not normal years. We're starting to get a little bit more into normalcy, which is why instead of seeing home prices go up 20% a year, we're getting back to seeing them go up 3, 4, maybe 5% a year. As I mentioned earlier, consumer sentiment is hitting all-time low in America, not just for the present, but you can also see for the future. But as I've said before, when consumer sentiment is low, that is when I buy. I started buying real estate in 2008, bought my first property, 2009, 2012. Look where consumer sentiment was. That's when you buy. I bought again a lot of real estate, 2020, 2021, when it's low, and I'm buying again now. A wise person, one of my professors once told me that you have about 7 opportunities in your lifetime to become wealthy, about 7 opportunities. And it's not because you're playing the lottery 7 times in your life. It's because during an average American's working years, about a 40-year span, there's usually about 7 recessions. And you make your money by buying things like real estate during things like recessions, when consumer sentiment is low. Now, I'm not saying we're going into a recession, but I am saying whenever times look rough, that's when you should go all in. It blows my mind. Most people like to buy things at a store when they're on sale, but when things go on sale, like the stock market crashes, that's when everybody sells. That's the time you should buy. Now, real estate is not anticipated to crash, even with monthly job changes being at all-time lows, even with consumer sentiment being low. Real estate is not expected to crash, again, because of the supply and demand equation. We have this huge cohort of people in their 20s and 30s that want to buy housing, and we just don't have enough supply. So that should hold home prices high, as should mortgage rates going down. Now, we just had the Federal Reserve decrease interest rates again here this month, and they're likely to do so again 2 times next year. When the Federal Reserve lowers interest rates, it does not directly affect mortgage rates. And you can see that in the chart in front of you. Why is that? Because there's all kinds of investments out there investors can buy. They can buy federal treasury bonds, federal treasury notes. They can buy mortgage-backed bonds. The federal funds rate that you hear about on the news, Federal Reserve lowering rates 0.25%, that's the rate that banks use to lend money to themselves and to and from the federal government, overnight rate. The rate you get on your mortgage is more closely related to the 10-year treasury. The 10-year treasury is simply a 10-year long bond that investors can go out there and buy. I've got some slides and we'll get into the 10-year treasury in a minute. But a couple last ones from the National Association of Realtors that I think are very interesting, and I hope you find interesting too. Number one, compared to 40 years ago, 1985, 75% of home buyers were married couples. Today, only 50%. And I can tell you, as a team leader of a team that sells about 150 homes a year, I personally notice about half of our contracts are individuals buying a house, not married couples. The next one, 1985, single women were only 11% of buyers. Today, they are a quarter. Single women are buying homes at 2.5 times the rate of single men. Take a look down here. Single men are only 10% of buyers. Single women, 25% of buyers. I'm not sure what brought around that shift, but I can also tell you, looking at contracts, I am seeing that shift firsthand by seeing a lot of single women out here in San Diego buying real estate. Unmarried couples, that would just be a couple buying a house together and they are not married. And then the last one, other, those are just friends. Every now and then we see someone who wants to buy a house, they can't afford it, neither can their friend, but together they can afford it. They're not a couple, they're not married, they're just out there buying. But I think these demographic trends are very telling, very interesting. Less folks buying when they're married, more folks buying when they're single. Specifically, women out there are buying. So, what's the forecast from the National Association of Realtors? And again, this is national data. Usually, San Diego data is a bit more amplified because we usually appreciate more than nationally. But as we look into 2026, it's anticipated existing home sales to pick up 14%. So it'll be a lot more transactional activity next year because interest rates are likely going to continue trending downward. New home sales, that's just new development. They'll probably pick up about 5%. The median home price in America went up 3% this year. The median home price in San Diego went up about 3 to 4% this year. Next year, it's expected nationally home prices to rise another 4%. San Diego, again, will likely be on par, if not a little bit greater than the median home price appreciation nationally. Mortgage rates are expected to drop. We started the year in the high sixes. Next year, it's expected to remain in the low sixes, maybe even dipping into the fives. I wouldn't anticipate rates going down into the fours, but seeing something in the high fives is certainly not out of the question. Job gains. The economy is likely to remain somewhat slow. Folks were hoping for 2 million job gains. This year we saw about 400,000. Next year, probably more at 1.3 million, but still not that magic number of 2 million. And unemployment is expected to tick up, but not a lot. So not a lot of major movement next year other than these two things. More real estate transactions will likely happen, and real estate values will likely go up faster than the rate of inflation. You saw inflation now is at about 3%. Home prices are expected to go up 4% plus next year. As far as interest rate cuts, it's anticipated, based on the latest survey, that the Federal Reserve will do 2 interest rate cuts next year. The first one likely being around June, and the second one being towards the end of the year around December. Now, of course, this can change based on economic data and what happens with jobs and with unemployment. If unemployment starts skyrocketing, then you can better believe the Federal Reserve would start cutting rates even faster. This is an interesting chart to show you how demand goes up as interest rates go down. The orange line that you see on the chart in front of you is interest rates. And again, coming out of the pandemic, you can see we had extremely low interest rates, around 3% or lower. They screamed all the way up above 7%. And over the last year or so, well, they got close to 7. We've been in the sixes most of the year. And we saw interest rates in 2025 coming down during the last 3 to 4 months quite a bit. And with that, the blue line is mortgage purchase applications. How many people are out there looking to buy a home? And we can see that throughout 2025, as interest rates went down, mortgage applications went up. I don't have to tell you that demand goes up as mortgage rates go down because I can show you. You can see it in the chart right in front of you. Demand will continue increasing as mortgage rates go down. Again, why I'm buying real estate right now, because I don't want to wait until demand starts skyrocketing as rates go down. This Mortgage News Daily chart simply shows you in a real zoomed up way what happened to interest rates throughout the last 12 months. And as we can see, it was really the last quarter of this year that we saw interest rates going down significantly. Hence why the last quarter of this year where we saw demand picking up quite a bit. Now, I mentioned earlier that the 30-year mortgage is not directly related to the short-term federal funds treasury rate. It's more so directly related to the 10-year treasury. Now, I want to dive into that a moment. You can look at graphs that show 10-year treasury bills and 30-year mortgage rates and how they kind of mirror each other. And usually, historically, there's about a 1.7% spread between 30-year mortgages and 10-year treasuries. What do I mean by that? Usually, the 30-year mortgage interest rate is about 1.7% higher than the 10-year treasury interest rate, an investment that Americans can invest in, 10-year treasuries. Well, COVID was a risky time. And investors, and when I say investors, I don't mean you and me, I mean big hedge funds and banks on Wall Street that are buying mortgage-backed securities. They saw mortgages as a little bit riskier than usual coming out of the pandemic. So in 2023, they wanted a higher spread. And mortgage interest rates, thus, in 2023, were about 3% higher than 10-year treasury bills. You can see that right here in the pink line. In 2024, real estate became a little less risky in the eyes of investors, so there's a 2.5% spread. Now, in 2025, you can see that spread has gone down even lower to just above 2%. What does this tell me, and what does this tell you? It tells us that the analysts on Wall Street, year over year over year in the last few years, are seeing real estate as a less and less risky investment, a safer and safer investment. Thus, they're buying more and more 10-year 30-year mortgages. And all of these mortgages that you, me, your parents, your friends, your coworkers, all of these mortgages that you and I go out and get, they get sold to Wall Street investors. More and more investors want them. So because they're a safer investment. So the spread between the 10-year treasury and 30-year mortgages has been trending down. That trend will also continue. It'll likely keep on gliding down towards that 1.7% norm, which means even if the Federal Reserve didn't lower interest rates at all next year, we could see mortgage rates drop another 0.25 to 0.5%. Even if the Federal Reserve did nothing next year, see mortgage rates go down. But with the Federal Reserve lowering rates, I anticipate rates will end up in the fives next year. Maybe the high fives, but the fives. That's a little different than National Association of Realtors. They're anticipating rates next year to be 6.00. I'm going to go a step further, and I'm going to say they're going to be in the fives. Make a bet with anyone who wants to on that, but I think we'll see a 5 handle as the first digit on interest rates for mortgages some point in 2026. Housing inventory, as much as we have said, housing inventory has gone up in the last few years. Let's take a step back and look back 4 decades, and you can see housing inventory is still extremely low. And I share this with you because you're probably hearing on the news or maybe podcasts or friends you listen to or a different real estate agent that housing inventory is so high right now and demand doesn't meet supply. And I would say that is simply not true. I would say housing inventory has gone up in the last 24 to 36 months, but look at it compared to the long-term averages. We are nowhere near where housing inventory needs to be to have a balanced market. Certainly not near where it was 2008-9 during that Great Recession. The Great Recession, that was a big supply glut, way too much inventory. Again, usually in America, there's about 2 to 2.5 million homes for sale. And right now we're sitting at about 1.5 million. So still a huge lack of supply. And I already showed you the chart showing all that demand of millennials and Gen Z. Because of the lack of supply relative to demand, we have seen real estate values go up a lot. Thus, we have seen real estate owners' net worth go up a lot. This is why back in 2020, way back here, I told all my friends, my family, and all of my clients, buy real estate as much as you can now, back in 2020, because you could see the writing on the wall. And I could see the writing on the wall, not because I'm a real estate agent, but because I have 2 master's degrees in real estate, finance, economics. And I always say, if you want to know what's going to happen to real estate, don't look at real estate, look at economics. And back in 2020, my team and I called it. We said prices are going to skyrocket. And sure enough, look what happened. We saw the net worth of many of our clients also skyrocket. Also, I recommend you watch all of our quarterly YouTube market updates because you get info on what to do and what not to do. Healthy equity. This is the question that you can see for homeowners. 86% of borrowers, of homeowners, have at least 30% equity in their home. We have never seen a time like this. Going back decades, we have never seen homeowners with so much equity. In fact, look at the percent. About 75% have over 40% equity in their home. Because real estate is so strong right now, it's one of the strong parts in our market. We're seeing foreclosures at all-time lows. Guys, look back, going back a quarter of a century, the red line is the percent of homes, percent of mortgages that are in foreclosure. And as you can see in the red line, near historical lows. The orange yellowish line is the number of mortgages that are seriously delinquent. And as you can see, also at historical lows. So all the doomsday sayers out there, all the chicken littles out there that say the sky is falling, it is not. It is not falling in real estate. In fact, real estate is probably one of the strongest assets right now in the United States of America. Bitcoin goes up and down. Stock market, I've been hearing people say it might be overvalued. But real estate absolutely is not overvalued. In fact, homeowners have a ton of equity in it. Supply is still far less than demand, and foreclosures are at all-time lows. Now, where am I concerned? It's not real estate. It's consumer debt. It's a lot of the folks out there who aren't buying real estate. Auto loans, delinquency of auto loans is starting to hit all-time highs. Not only are auto loans starting to hit all-time highs, but we're also seeing that with credit card debt. We're also seeing that with student loan debt. A lot of the deferments went away for student loans, so we're seeing a lot of student loan debt become delinquent as well. These are all feeding into that low consumer sentiment, and all of this also feeds into me saying in black and white, you need to own assets, you need to own real estate if you don't want to fall behind in this economy because of what has been happening and what will continue to happen over the next decade or so. Now, as we look forward into 2026, GDP, what is that? Gross domestic product. That's really a fancy term for the economy. How is our economy doing? Is it growing or is it shrinking? And we can see here, usually gross domestic product, the growth of our economy in America is usually around 2%, 2 to 3. And we saw Q1 2025, the economy actually contracted. The economy shrank. It grew Q2. Q3 and Q4, there was a lot of data that didn't come out because the government was shut down for about a month and a half, as you know. But it's estimated we're going to have a little bit of growth during those 2 quarters. 2026, as an entire year, it's anticipated the economy will grow, but just below 2%. So no big shock waves in 2026. At least that's the anticipation. Now, we're going to zoom in a little bit with a microscope on what's going on in the San Diego market. If you want to buy a house, you want to buy a condo, let's talk about that for a second. Homes are selling a lot faster now than condos. Condos are kind of sitting. You can see here the average days on market for a home detached is 88. Average days for a condo is 119. Why is that? Here's another thesis statement, overarching blanket statement. That's true. The rich are getting richer, the poor are getting poorer. And who usually buys a single family home in San Diego? A single family home is easily going to be $1 million to $2 million starting price for a single family home. Those are usually people with the means, higher paid people, people with a bit more wealth, right? They're not being affected as much right now in this economy. Lower income, middle class folks as well are being hit pretty hard. We saw auto loans going up. We see credit card delinquencies going up. Those are the folks usually buying their first home. First home in San Diego is usually between 400 and 800,000, and those are usually attached. Those are usually condos. Those are usually townhomes. That's where we're seeing the market slow down the most right now because those buyers are getting hit the hardest in the economy. Although as much as we're seeing days on market, the time it takes to sell a home or to sell a condo increase is not as bad as other cities. Look at San Diego right here. Expected market time to sell a detached home, 119 days. Expected time to sell a detached home, 88 days. So that'd be like a single family home. But when you look at some other marketplaces, Las Vegas is taking 224 days to sell a condo. Phoenix, 160. Riverside, 170. Why is it? Again, because these are, to be blunt, lower income areas. Las Vegas, Phoenix, Riverside, not as much money there. People are not as wealthy. And thus, those markets usually get hit the hardest. One of the reasons I don't invest in those markets. Now look at a market that has even higher wealth than San Diego. That would be Orange County. Orange County, faster market, 95 days versus our 119, 82 days versus our 88. This is why I always invest in expensive markets. And people say, Patrick, why don't you invest in the Midwest where it's cheaper? Because if you buy cheap things, you receive cheap results. If you buy high-end things, you receive high-end results. And I would rather invest in an Orange County or San Diego where you're going to hold value and appreciate more than some of these other areas that take hits harder when times get tough. Now, active listing inventory year over year, listings are starting to come down a little bit, which is normal. It's the holidays. There's not as much out there to buy, but there's still about 5,000 homes for sale in San Diego. As I mentioned earlier, real estate market usually peaks around June, and you can see that right here. So most of my clients, I always say, if you're going to sell your house next year, go to market around March or April, ride that wave up. Do not go to market in July or August because you don't want to ride the wave down. So supply is higher than it's been the last few years, but still not as high as it was before the pandemic, the green line that you see up here. Demand is about where it's been the last few years. You can see all these little colors at the bottom. That's 2022, 23, 24. Number of homes going into contract, offers being accepted. Demand is kind of like where it's always been. But let's take a look. Supply was higher, right? So a little bit higher supply. Demand's kind of where it's been. That's why we have seen days on market pick up a lot. But you'll see in a minute that prices have remained relatively the same. Prices have kind of bounced around 1 to 1.1 million for the last 3 years. Expected market time, I already mentioned how it's taking a little bit longer for homes to sell. We all know this, but it really varies based on the price point. The sweet spot in San Diego is 750,000 to 1 million. So that would be like a starter detached home or a really nice condo. And we can see 72 days on market where we see that's 20% of inventory and about 27% of demand. If you work with our team, this is one of the charts that we look at every time we're working with someone who's selling real estate to get a realistic expectation of how long it's going to take to sell a home. What's a percent of the demand there? Now, I mentioned about 5 minutes ago that I think we'll see a 5 handle on the front of interest rates next year. And we know through experience and also through data, when rates go down, buyer demand increases. Buyer demand usually gets very strong when rates drop below 6. And that is likely going to happen next year. Again, that's why I'm saying if you're a buyer, you might want to get out there now before it becomes too late and prices go up too much because you have too much competition. I would buy while rates are still in the 6. Real estate acts a lot like a bond, and it's a whole 60-minute class I could go into, which we don't have time for today. So just push the I believe button, but this is something they teach in every business school. When interest rates rise, the price of a bond, the face value of it, goes down. When interest rates fall, the price of a bond goes up. Again, it's a whole 60-minute thing I could get into, but why does this happen? Because bond is a fixed income asset. Real estate is also a fixed asset in the fixed income asset category of Finance 101. So believe me, when I say when interest rates fall, real estate prices go up. Happens to every financial asset in the world that is a fixed income type of financial asset, like real estate, like bonds. So as we see rates continue to go down, we will certainly see the value of homes go up. Now, the San Diego current real estate market data. A few more slides on this I want to dive into. I always say it doesn't matter how many people move in and out, matters where they move from. And as you can see, most people moving to San Diego are coming from Los Angeles, San Francisco, the entire Bay Area, Orange County, Boston. They're coming from higher price markets, and they're usually selling a home there, bringing their money here, causing our prices to remain strong. San Diego population is still growing. We already discussed that. You can see the annual change, the growth of our population in the green line, and you can see the total population size in that blue line. Right now, we're sitting around just below 3.4 million. It's expected over the next 10 years, we're going to gain a few 100,000 people more in the San Diego region. I already mentioned how the inventory of homes for sale has gone up. You're hearing that nationally, that there's a lot more homes for sale now than there were a couple of years ago, and that is true. But again, I showed you the national data. Now I want you to see it in the San Diego specific data. The amount of homes for sale in San Diego is still anemic compared to the amount of homes we have for sale pre-COVID. Usually a normal market before COVID, there'd be around 10,000 detached homes for sale. Today, it's less than half of that, less than 4,000 homes for sale. And for condos, we used to have around 4,000 for sale, and now we're sitting around 3,000 for sale. What's becoming a very rare luxury item in San Diego is a detached home. This is why I get asked this question all the time. Patrick, what's going to appreciate more, a detached home or a condo? Bar none, a detached home will appreciate more. Why is that? Because we're not making any more of them. And when you stop making something, it goes up in value faster than what you keep on making. And we're just not making any more detached homes. You can see it on the chart, how much that has dropped off the edge of a cliff. Inventory of homes for sale, seasonality is starting to go down in San Diego, as you previously saw. Percent original list price. I just had a client ask me the other day, do homes sell for list price, more than list price, below list price? Well, the average home in San Diego is selling for about 97% of list price, but that's the average. It really depends on the specific property. Some homes are selling for more than list price, some are selling for less than list price. Usually, it depends on the type of market you're in, but very often real estate agents will list a home right below what it's worth to get multiple offers in. So it really comes down to the specific property, but the average is about 98%. Again, months of supply of inventory, we have a lot less inventory relative to demand of single family homes compared to gray attached homes, condos. Month supply of inventory just simply means if all the homes on the market today, how long would it take them to sell if no new homes came to market? And we can see about 2.2 to 3 months, depending on detached or attached. A balanced market is 6 months inventory. So this tells us we're still not balanced. We still don't have enough supply. And that's why we're seeing the median sales price go up. I mentioned a little bit ago that the median sales price of a detached home in San Diego throughout the last year has bounced between 1 million and 1.1. And here it is. We started the year at 1 million. By March, we're at 1.074. And by July, remember I said the market usually peaks around May, June, July. In May, 1.09. And in July, 1.099. Almost 1.1 million. Then, as it always does, prices started dropping throughout the fall, August, September, October. But look what happened in November. We almost got down to $1 million median sales price, and then all of a sudden November jumped up to 1.05. Why did that happen? Well, if you've been paying attention, I don't need to tell you, it's because interest rates went down and we saw home prices start going back up again. So year over year, the change has been 3% net increase. Same thing's going on with attached homes, condos, just not to the same extreme. I'm going to go a little bit over the hour, but I think it's worth it. And if you have to sign off, no worries. You can always check it on the YouTube channel. But I want to talk a little bit about payments. In San Diego, we have not found a ceiling on how high home prices can go. we only found a ceiling on how high monthly payments can go. For the median household income in San Diego, the average payment that the average family can manage is around $5,000 a month. Why do I say that? Because look back at the last 2 or 3 years and you can see the peak in the monthly payment. We peaked out around $4,907, right here at this magic $5,000 a month line. Why is this important for you to know? Because as interest rates go down, that doesn't mean a buyer is all of a sudden going to get a lower monthly payment, because we've already proven over the last 3 years that buyers in San Diego can afford about $5,000 a month. So as interest rates go down, what we will likely see is home prices will go up. Buyers will still be paying on average about $5,000 a month. Some pay more, some pay less, depending on the home that they buy. This is the average. But as interest rates drop, home prices will go up. We can see here that a drop from 6.5% to 5.5% drops rates by $477. And that's a 6.5% to a 5.5%. That's a realistic drop that could happen in the next 12 months. That drop is about a 10.1% drop in monthly mortgage payments. But as I said, San Diego hasn't hit a ceiling of prices. It hit a ceiling of monthly mortgage payment affordability. So what happens when rates go down, and we see this happen every single time rates go down, is home values go up, typically an equivalent percentage increase. So if a 1% drop in mortgage rates would cause a monthly payment to go down 10%, instead of causing the payment to go down 10%, it causes the home price to go up 10%. So median home price that we saw at the peak of last summer was 1.1 million. If that goes up 10%, that's an extra $110,000 you have to pay. And this is why I tell my clients, buy now, or you could wait until rates go down. And if you wait until rates go down, you'll probably pay about $100,000 more in this example. Or you can do what I'm doing, buy now at today's price. And when rates go down, you just refinance into that lower interest rates. That's how you save the $477. And not only then do you save $477 a month for the rest of your life, but your net worth goes up $100,000 because that property that you bought today for $1 million goes up 10% as rates go down. This is finance at the 400 level, but this is the way you do it. As it says here, 1% drop in rates can cause real estate values to go up 10%, as we just illustrated. So what you do, wait to buy or buy and then wait. As I mentioned now, I'm not waiting, I'm buying, and there's a picture of the home that I'm closing on Tuesday. I'll be closing escrow on this on Tuesday, the next investment property to add to the portfolio. So as I started at the beginning, if you don't want to be left behind, you need to own real estate or you will be left behind economically in today's economy. And we're going to close it out with one last thing, the magic of math. I love math. And if you think about it, folks, math is universal language. There are probably hundreds, if not thousands of languages throughout the world, but we all speak math the same, no matter what country you're in, because words can lie, words can be deceiving, words can be misleading, but math doesn't lie. So let's look at some real quick math. What if you could rent a place for $3,000 a month, or you could buy and own that same place for $3,990, almost $4,000 a month? Which one would you do? Which one is cheaper? Now, when I say which one is cheaper, most people would say $3,000 a month is cheaper than $3,990. I'm going to show you some math, and I'm going to show you how $3,990 a month is cheaper than $3,000 a month. Now, we have to assume that you're going to live for 10, 20, 30 years. Okay. And I built this Excel spreadsheet when I was in graduate school getting a master's degree in real estate. I'm not going to bore you with all the fine details because this Excel spreadsheet goes down 360 lines because a 30-year mortgage has 360 months. And I wanted to truly calculate how much would a renter pay in San Diego versus how much would a homeowner pay over the long term. Because most podcasters and news reporters and your mom and dad would probably say you should rent because renting is 3,000 and owning is 3,990. And I would say they are absolutely wrong. 3,990 is a lot cheaper. So let's zoom in. When we're going to zoom in, top left of this Excel spreadsheet where you see rent versus own and all these pretty colors, we're going to zoom in on that. And here is a great case study example. I know this property very well because I own it. It's a condo in Little Italy downtown. It's worth about $500,000, $500,000. Now, let's say you go out and buy it. You put down 5%. I'll tell you right now, you don't even need to put down 5%. You can put it down with none of your money because our team can get you a grant, money from the government to buy your first home. So most of our first-time home buyers, many of them, we connect them with a lender that can get them government grants to cover their down payment, so you don't need to have your own down payment. So let's say you put down 5%, 25,000, you borrow 475. Let's say your interest rate 6.5%. Well, you have to pay your mortgage, which is principal and interest. You also have to pay real estate taxes. You also have to pay real estate insurance, and you also have to pay HOA fees, or if it's single family home, no HOA fees. But nonetheless, when you add all that up, it comes to about $4,000 a month, $3,990. Now, if you don't rent this place, if you don't own it, if you don't buy this condo, you can rent it. I have tenants in it right now. Now, the average rate of appreciation in San Diego County is about 6%. If you go back 35 years, over a quarter century, average rate of appreciation 6%. You can rent this place for $3,000, and rent's going to go up every year. In San Diego, rent, even with rent control, rent can go up between 5 to 10% a year. So let's uncover payment year one. If you own it, you're paying $3,990, and if you rent it, you're paying $3,000 a month. So most people would stop thinking there, and they would say, well, it's cheaper to rent than it is to own, so I'm going to rent. That's your mistake. Don't stop thinking there. You need to look into the future. So let's look into the future. When people say you can look at the past, you can look at the present, but you can't look into the future, that's wrong. With math, you can always look into the future. So let's look into the future. Over the next 30 years, if you own this place, how much will you pay? 1.597 million. If you rent this place, how much will you pay? 2.391 million. How is that? It's because if you're renting it today for 3,000 and your rent goes up just 5% a year. Remember, rent can go up 5 to 10% a year, and it's usually closer to that 10. But if you have a nice landlord and they only increase it 5% a year, you will pay almost 2.4 million over the next 30 years. The owner saves almost $800,000, $794,000 to be exact. So even though the owner pays a little bit more on day one, they pay a lot less over the next 30 years. This is why owning is always cheaper, but it goes further. Let's look at year 31. Let's say you're in your 20s or 30s right now. Someday you're going to be in your 50s or 60s. 31 years into owning this. If you own it, you've paid off your mortgage. So now at year 31, all you have to pay is your taxes, your insurance, and your HOA. And even if those go up at the rate of inflation, your payment's now $2,000 a month. If you rent it, your payment is $12,348 a month. That's a month, not per year. Who can afford $12,000 a month? Not me, and I don't know if you can, but that's what you'll be paying if you keep on renting forever. Because if you're renting today at $3,000 a month, and if the rent goes up just 5% a year, year over year, for the next 30 years, that number quickly becomes $12,000 a month. This is why I say the only people that can afford to rent are the wealthy. Because if you look at the math, and the truth is most people don't look at the math. That's why they don't understand this stuff, but it's important that you do. If you look at the math, you can see that renting is very expensive. and it gets more expensive as time goes on. That's why I also say the only people that will ever be able to retire in their lifetime are homeowners, because your payment goes away or at least goes down. And if you rent, your payment for the rest of your life only goes up to the end of your life. It's horrible. This is why you must own. And then there's the other big one. As much as you pay 800,000 less if you own, and when 31 years from now you're paying 2,000 a month instead of 12,000, guess what the other big thing is? You might be thinking, why would I buy a $500,000 property if I got to pay 1.597 in mortgage? Because that property also appreciates, and appreciate the average rate of San Diego appreciation, it becomes a $3 million property. A $500,000 property today, appreciating at 6% a year over year for 30 years, will be worth over $3 million 30 years from now. You become a multimillionaire. I guarantee you this. You can become a multimillionaire. No reason you shouldn't. And it's not because you're going to work hard. And it's not because you're going to play the lottery. And it's not because you're going to inherit it. It's because you're going to own one condo. All you have to do is own one condo in San Diego and you'll become a multimillionaire. Just let time do the work. Now, to close it out, home ownership remains the number one feature of the American dream. Most folks still want to own a home. They just find it hard to do. Gen Z and millennials, you saw a lot of them want to own a home. Many of them don't yet. Why do they find it hard? This is what they think are the roadblocks. But trust me, they're not roadblocks. Most of them think you need to have a lot of savings. You can see 21.9% think they don't have enough savings. Truth is, you don't need a lot of savings to buy your first home. When I bought my first home, 2008, it was a condo, and I didn't even need a down payment because I used a government grant to buy my first home, and you can too. 20.8% of people think a roadblock is they don't know where to begin. Well, the way you begin is you give me a call, you contact someone on my team. It usually looks like a one-on-one meeting on Zoom or in person, and we spend about an hour or two with you to learn more about you, what your real estate goals are. We teach you more about real estate, and then we help guide you through the process, holding your hand the entire time from the first meeting to putting new home keys in your hand. So if you don't think you have the down payment, you don't need it. If you don't know where to begin, give me a call, shoot me an email. We will definitely be able to help you buy your first home. These are some of the down payment assistance programs. They come from San Diego Housing Commission. They come from the California Housing Finance Agency. You can see here as an example, someone buying their first condo, 600,000, down payment assistance, you get 21,000 for free. In fact, over the last year or two, our team, Kappel Realty Group, has gotten over $1 million to go to our clients, not to us, to our clients, towards their down payments. So if you want some free money to go towards your down payment, definitely reach out. We're here to help you. And always remember this phrase, which I love to end my seminars on. In order to cross the finish line, you must first cross the starting line. And I share that quote with you because everybody in life wants to cross a finish line. Everybody in life wants to own real estate. Most people are not afraid of crossing finishing lines. They're afraid of crossing the starting line. And if you want to buy your first property or your first investment property or your 10th, you have to get over your own fear, step up to the starting line and cross it, and we'll help get you across the finish line. And the starting line, like I said, what does that look like? A phone call, an email, reach out to me, reach out to someone on my team, and we will help you cross the starting line, and we'll go with you the entire way across the finish line. With that, I end the presentation tonight reminding you that in all things in life, who you work with matters. The picture you see in front of us is our team, Kappel Realty Group, one of the best teams in the United States, definitely number one large team in San Diego, based on the number of transactions we do every year in the city of San Diego. Feel free to reach out to us. We'll help you. And also, one last reminder, check out that YouTube channel. There's a lot more videos that you'll find, I think, very educational and very informative. I'd also like to invite you, follow me on Instagram, Facebook, And call, text me. That's my cell phone. That's my email. And I get back to everyone that reaches out. Always happy to help a new client. And with that, I'll close out the seminar, the webinar for tonight. I hope that you learned something and got something from everything that we shared this evening. Enjoy your holidays, and we'll see you in the new year.